Securing capital for growth. Last video, I'll put the clip here, we talked about securing capital for acquisitions. When securing capital for the growth of a business in other avenues, whether it's hiring, marketing, expansion, new markets, new products, right, it's going to be a slightly different narrative. And today we want to talk about the steps or the components of the narrative to optimize the probability of getting that capital and the terms on which you'd be able to get it for. So first thing to consider is that this capital takes different shapes, right? Could be debt, could be equity. Think of it as a continuum, not a binary. Could be purely debt, could be purely equity, could be equity with debt components, fixed payment, could be equity with debt components, coupon payment. But things to keep in mind. Think of the objective back into the structure. So similar to capital for acquisitions, the first thing is a plan. What is the strategy? What are we going to try to accomplish here? And why does it make sense? Why is this a good use of capital qualitatively before we dig into the details? Next, what are the steps? So assuming you have the capital that you need, what is the growth strategy that you're looking to implement? And it may be, well, we want to hire this many people, we want to get into this type of product, we want to get into this type of market, we want to expand our budget for this, whatever it may be. What are the boxes that are looked to be ticked? Next, sources and uses. So if you think of sources as where you get the capital from, uses is how you allocate it. So go to the steps of the plan and start putting a number to each one of these. Well, if we hire this many people at $60,000 a year, it's going to cost us this much. If we get into this market, we're going to have to pay marketing budget for this much and boots on the ground of this much. But if you can define all of these things and go to somebody and say, here's how much we're asking for, here's precisely how I'm going to utilize them, here's the steps, and here's how these steps lead into the overall plan, you're going to instill a lot of confidence as to why someone may want to give you the capital. The last two steps really help in fully baking out that kind of comprehensive pitch. And so if you say, okay, here's how we're going to use the capital, what are the results going to be? And so again, start qualitative, pivot to quantitative. So we always like to say, well, qualitatively speaking, if we enter this market, we will end up acquiring X% of market share from competitors. If we hire this many people, we'll get this many more leads or outbound communications or meetings a month that ultimately lead into the funnel of business. If we hire this much of an operating staff, we can now process this much more business that comes in. But whatever it is, right, start painting the picture of what are the results of the capital allocated. And lastly is what are the quantitative considerations of that? And so as we say in a lot of our videos, how does this all boil down to the future profitability of the business, right? Because if you say, I have a business that makes $3 million of pre-tax profit a year, I can deploy $5 million of investment or $10 million of investment to grow this business to a business that now generates $6 million of pre-tax profit a year, right? And what does that mean from a value differentiation? Well, think about it. If you have a $3 million EBITDA company and say it's worth 7 times EBITDA, it would be worth $21 million. If on the other hand, you have a $6 million EBITDA company and perhaps it trades at an 8 to 9, let's say 9, just to show kind of the multiples expansion, EBITDA multiple, well, now it's worth $54 million, right? And so you go from $21 million to $54 million. So if you can show that you can implement or allocate $10 million of growth and it will ultimately yield a meaningfully larger amount of enterprise value distinction. So again, 21 million to 54 million, $33 million of incremental enterprise value for $10 million of investment. That ROI is solid. And again, if you can get the capital provider comfortable via the narrative that the probability of achieving this outcome, even if everything does not go perfect, is high, then they're going to be very inclined to do it. But that's the process, that's the narrative that needs to be communicated. And so the steps to the exercise are, have a plan. What are the steps to the plan? Understand the sources and uses and how you're specifically going to allocate that capital. What are the results from a qualitative perspective and how does that boil down to a growing enterprise value from a quantitative perspective? If you have all of that put together, that's going to be a pretty compelling narrative and it's going to instill a lot of confidence in the capital provider that, hey, this company knows what they're talking about and knows exactly what they would do with the capital. The wrapper to all of this and the insight we'd like to share may sound like common sense, but have a very specific timeline, right? There's a lot of companies that say, hey, if we had $5 million of debt, we would probably do this and probably do that. And over the next few years, we think it would generate this kind of a return, right? But when you think about debt in particular, you're saying there's a fixed timeline to the repayment of the debt. There are coupon or interest payments along the way. And therefore, if there's a finite duration to the capital, there needs to be a finite duration to the plan to make sure that it is accomplished in an adequate amount of time, right? Like if you said, hey, I'll give you $1, and I said, great, I'll give you $3 back. Well, whether I give you those $3 back a year from now or 20 years from now makes an enormous difference as to the return, right? And so even equity, as much as it feels like, hey, here's just capital to grow the business, the investors of equity have a duration in which they want to be invested in the company, after which they want it to be monetized, right? And so the return on invested capital what are the two variables? One, how much you get back, and two, when do you get it back? And so we want to solve that problem for the capital provider as part of the discussion, right? Let's walk through the steps of the narrative. And then lastly, here's the timing of everything. Here's when your capital comes in. Here's when your capital goes back. This is what the returns look like. If you paint that picture for somebody, here's the runway, it does a lot of the homework for them, and it gives them confidence that you've thought from their perspective, not just your own self-interest. Again, increases the probability and the terms you may be able to accomplish. That's a thought for today, securing capital for growth. Hope the week continues to go well for everyone. Keep pushing forward. God bless. See you next time.